Hey everyone, it's Smart Cash. Now I don't have a crystal ball, but lately, everyone on Wall Street's been whispering about one thing: recession. Some say it's coming in 2025, some say later, but honestly, trying to time the market is like trying to predict when your toast will burn. You're better off just keeping a close eye on it. But here's the thing: recessions aren't the end of the world. In fact, they can be huge opportunities to grow your wealth, if you know where to look. Think about it. When everyone else is panicking and selling low, that's your chance to buy low and watch your investments soar when the market inevitably recovers. That's what we're talking about today. The top 10 investments that could not only weather the storm of a 2025 recession, but actually come out stronger on the other side. We're diving deep into each one, looking at the pros, the cons, and everything in between so you can make the smartest decisions for your financial future. Let's get started. First up, let's talk about everyone's favorite tangible asset, real estate. Now, I know what you're thinking, Graham. Didn't the housing market just go crazy? And yeah, it did. But here's the thing: real estate is cyclical. It goes up, it cools down, it goes up again, and historically, even during recessions, real estate has held its value pretty darn well. Why? Because people always need a place to live, right? Plus, owning property gives you this great hedge against inflation. Think about it: when prices go up, so do your rents. Now, I'm not saying you should go out and buy 5 rental properties tomorrow. Real estate is a long-term play, and it's not without its risks. You've got property taxes, maintenance, maybe even some interesting tenants to deal with. But if you're looking for a stable investment that can generate passive income and appreciate over time, real estate is definitely worth considering. Just remember: location, location, location. Do your research, find properties in desirable areas, and don't over-leverage yourself. Next up, we've got the OG of safe haven assets, gold. For centuries, whenever there's been economic uncertainty, political turmoil, or just a general sense of, oh crap, what's happening, people have flocked to gold. And you know what? They're onto something. Gold has this intrinsic value that doesn't depend on any government or central bank. It's tangible, it's finite, and it's always been seen as a store of wealth. Now, I'm not saying gold is going to make you rich overnight. It doesn't pay dividends, and its price can fluctuate in the short term. But, as a way to preserve your capital during a recession, gold can be a smart addition to a diversified portfolio. You can invest in physical gold, like coins or bars, or you can go the ETF route, which tracks the price of gold. Just remember, like any investment, do your research and understand the risks before you jump in. Now let's talk about a way to actually make money during a recession: dividend-paying stocks. See, when the economy takes a hit, some companies might cut back on their growth plans or even lay off employees. But established blue-chip companies? They often have these massive cash reserves and consistent earnings, which means they can keep paying out dividends to their shareholders like clockwork. It's like getting paid to wait out the recession. Now, not all dividend stocks are created equal. You want to look for companies with a long history of paying dividends, a solid track record of profitability, and a strong competitive advantage in their industry. Think consumer staples, healthcare, utilities, those essential businesses that people rely on no matter what the economy's doing. Of course, there's always the risk that a company could cut its dividend, so it's important to diversify your holdings and do your due diligence. But if you're looking for a way to generate passive income and potentially benefit from stock price appreciation when the market recovers, dividend-paying stocks are definitely worth considering. Alright, let's talk about the snooziest investment out there. Government bonds. I know, they don't exactly scream exciting, but hear me out. When the stock market is in a free fall and everyone's running for the hills, government bonds become everyone's best friend. Why? Because they're considered one of the safest investments out there. You're essentially lending money to the government, and they promise to pay you back with interest. Now, the returns on government bonds aren't going to make you rich quick, but they offer something even better during a recession: stability. They act as a ballast in your portfolio, offsetting some of the volatility of your riskier investments. Plus, when interest rates rise like they often do during inflationary periods, which can happen during recessions, the value of existing bonds tends to go down. So if you buy bonds when rates are high, you can potentially lock in those higher yields and benefit when rates eventually come back down. Now, let's talk about an investment strategy that's about as exciting as watching paint dry high-yield savings accounts. I know, it doesn't sound very glamorous. But here's the thing. When the economy's in the dumps and the stock market's doing its best roller coaster impression, sometimes the best thing you can do is play it safe. That's where high-yield savings accounts come in. They offer a guaranteed return on your money, which is more than you can say for most other investments during a recession. Plus your money's FDIC insured, so even if the bank goes belly up, you're protected up to $250,000 per depositor per insured bank. Now, I'm not saying high-yield savings accounts are going to make you rich. The returns are modest, especially with inflation being what it is these days. But they offer something invaluable during a recession: peace of mind. Knowing your money is safe and sound, earning a little bit of interest while you ride out the storm, that's priceless. Alright, let's talk about a way to actually make money in the stock market during a recession. Defensive stocks. These are companies that sell products and services that people need no matter what the economy's doing. Think toilet paper, toothpaste, groceries, utilities, the essentials that people can't or won't cut back on even when times are tough. Because these companies have consistent demand, their earnings tend to be more stable, and their stock prices tend to be less volatile than the overall market. Now, defensive stocks aren't going to make you rich overnight. They're not exactly growth stocks, but they can provide a sense of stability in a turbulent market and potentially even outperform during a recession. Of course, not all defensive stocks are created equal. You want to look for companies with strong balance sheets, a history of profitability, and a competitive advantage in their industry. But if you're looking for a way to stay invested in the stock market without exposing yourself to too much risk, defensive stocks are definitely worth considering. Let's talk about a way to diversify your investments and potentially reduce your risk during a recession: mutual funds. Now, I know what you're thinking, Graham, mutual funds? That's so old school, and yeah, they've been around forever. But there's a reason for that. They work. See, with a mutual fund, you're pooling your money with other investors to buy a basket of stocks, bonds, or other assets. This diversification is key, especially during a recession, because if one or two of your investments tank, the others can help cushion the blow. Plus, mutual funds are managed by professional portfolio managers who do all the research and make the investment decisions for you. Now, mutual funds do come with fees, so it's important to compare expense ratios before you invest. But if you're looking for a hands-off way to diversify your portfolio and potentially reduce your risk, mutual funds are definitely worth considering. Alright, let's talk about an investment that can help you fight back against inflation, which can be a real buzzkill during a recession: Treasury inflation-protected securities, or TIPS for short. Now, TIPS are a type of government bond, so you know they're backed by the full faith and credit of the United States government. But here's the cool part. The principal value of TIPS adjusts with inflation. So, as inflation rises, the principal value of your TIPS increases, which means your interest payments also go up. This can be a huge advantage during a recession when inflation can erode the purchasing power of your cash. Plus, TIPS are exempt from state and local taxes, which can save you some serious money come tax time. Now, TIPS aren't without their risks. Their value can fluctuate in the short term, and if inflation falls, your returns could be lower than traditional bonds. But as a way to hedge against inflation and potentially earn a decent return, TIPS are definitely worth considering. Now, let's talk about the wild card of the recession: cryptocurrency. I know, crypto's been getting hammered lately. But here's the thing, crypto is still in its early innings. It's volatile, it's risky, but it also has the potential to be incredibly rewarding. See, crypto is decentralized, which means it's not controlled by any government or financial institution. And some people believe that during a recession, when trust in traditional systems is low, crypto could become even more appealing. Now, I'm not saying you should go all in on crypto during a recession. That would be like playing roulette with your life savings. But if you're comfortable with the risks, and you believe in the long-term potential of crypto, it could be worth considering as a small part of a diversified portfolio. Just remember, do your research, invest only what you can afford to lose, and be prepared for a bumpy ride. Finally, let's talk about commodities. These are the raw materials that make the world go round: oil, gas, gold, silver, copper, wheat, corn, you name it. Now, commodity prices can be volatile, but they tend to do well during periods of inflation, which can happen during recessions. Why? Because as the cost of producing and transporting these raw materials increases, so do their prices. Plus, commodities are a global market, so even if one part of the world is in a recession, demand from other parts of the world can help support prices. Now, you can invest in commodities directly by buying futures contracts, but that can be risky. A simpler way to invest in commodities is through ETFs, which track the price of a particular commodity or a basket of commodities. Just remember, like any investment, do your research and understand the risks before you invest. So, there you have it, 10 potential investments to help you weather the storm of a recession. Remember, the key is to diversify. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, like stocks, bonds, real estate, and commodities. And most importantly, do your research. Don't just take my word for it. Talk to a financial advisor, read books, watch videos, and make sure you understand the risks and potential rewards of each investment before you put your hard-earned money on the line. Thanks for watching, and don't forget to subscribe for more financial tips and tricks to help you build wealth and achieve financial freedom.